Zeta Global Holdings, New York Stock Exchange Zeta, closed its most recent trading session on Friday, January 9, 2026, at $24.40, marking a solid gain of 75 cents or 3.17% for the day. While most investors are focused on the surface-level price action, the real story lies in the massive volume spike that accompanied this move. We saw over 10.9 million shares change hands, which is nearly 50% higher than the average daily volume for this ticker. This isn't just retail enthusiasm, it's the kind of heavy-handed institutional accumulation that suggests the big players are positioning themselves for a much larger narrative shift. The prevailing expectation for Zeta Global has been that it's just another high-growth marketing tech firm trying to ride the coattails of the current tech boom. However, the reality is that Zeta is quietly separating itself from the pack through a strategic partnership with OpenAI that was just detailed at CES 2026. This isn't a mere branding exercise. They are integrating advanced models directly into their Athena platform, effectively turning a standard marketing cloud into a predictive, autonomous system. While the market expects steady growth, the reality of this integration could lead to a fundamental re-rating of the stock from a service provider to a core infrastructure play for the enterprise level. When you look at the recent price movement, Zeta has been on a tear, gaining over 25% in just the last month. This momentum is breaking through technical resistance levels that had held since late last year. Professional traders are watching the $26.60 mark closely, as that represents the 52-week high. If Zeta clears that hurdle on this kind of volume, we aren't just looking at a rally, we're looking at a breakout into price discovery mode. Much of this push is coming from a significant short covering cycle. With short interest recently pegged at over 11% of the float, any positive catalyst like the OpenAI news forces bears to buy back shares, creating a mechanical tailwind for the price. This surge comes at a time when institutional activity is shifting. Heavyweight firms like Vanguard and BlackRock have maintained massive positions, but we're seeing a new wave of interest from specialized tech funds. For those using platforms like interactive brokers or looking for investment help through Fidelity, the data shows a clear trend. The smart money is increasingly comfortable with Zeta's risk profile. The company recently completed its acquisition of Marigold, which is expected to add roughly $190 million to the top line in 2026. This isn't just about getting bigger, it's about the data. Marigold brings in a massive trove of first-party consumer data that feeds directly into Zeta's AI models, making their predictions more accurate and their platform more sticky for Fortune 500 clients. Despite the recent run-up, there's a persistent skepticism surrounding Zeta's path to GAAP profitability. The company has been aggressive with stock-based compensation, which is a common point of contention for value-oriented investors on investing sites. The expectation is that this dilution will continue to hamper shareholder value. However, the reality is that management has already started pulling the levers to reduce this. They've projected a drop in dilution from a massive 15% in 2024 down to just 3 or 4% by the end of 2026. If they hit those targets, the EPS numbers will start to look incredibly attractive very quickly, potentially catching those who only look at the surface-level PE ratios completely off guard. Let's talk about what Zeta Global actually does for a moment to ground this analysis. They operate an AI-powered marketing cloud. Think of it as a massive brain that sits on top of a company's customer data. It analyzes billions of signals to figure out exactly what a consumer wants before they even know it themselves. Their Zeta marketing platform then sends the right message across email, social media, and connected TV. This is a high-margin business model once it scales, and we are seeing that scale happen in real time. Their super-scaled customers, those spending over $1 million a year, are growing at double-digit clip. This is the bedrock of their revenue stability. For the self-investing crowd or those using the Robinhood app for online investing, the volatility of a stock like Zeta can be intimidating. It hasn't been a straight line up. Back in late 2024, the stock faced a significant short seller report that caused a temporary crisis of confidence. But look at the recovery. The expectation was that the company would buckle under the pressure. The reality was a series of beat and raise earnings reports that proved the business model was not just intact but thriving. This resilience is a key characteristic of long-term winners in the tech sector. Looking ahead, several catalysts could keep this fire burning. The 2026 midterm elections are a major hidden tailwind. Political campaigns are moving away from broad TV buys and towards high-precision micro-targeting that Zeta excels at. This political spend is often high margin and provides a massive boost to the second half of the year. Furthermore, the full deployment of the Athena AI agent by the end of Q1 2026 will be the ultimate litmus test. If Zeta can prove that their AI can actually automate the complex functions of a chief marketing officer, the addressable market expands from simple ad tech into the much larger enterprise software category. Macroeconomic pressures are always a factor, and 2026 is shaping up to be a year of rotation. As the Federal Reserve moves towards a neutral rate, investors are looking for growth that is policy-insulated. Zeta fits this description well because marketing spend is increasingly viewed as an essential utility rather than a discretionary luxury in the digital age. If you can prove that every dollar spent on your platform returns $3 in revenue, you become recession-proof. That is the narrative Zeta is building. Now, I want to hear from you to see where the sentiment is sitting. Comment below how many shares of Zeta Global you currently hold, or if you're waiting for a pullback to the $22 support level before jumping in. Comparing Zeta to its peers provides more context for the valuation. While names like The Trade Desk trade at astronomical multiples, Zeta is currently trading at a price-to-sales ratio of around 5.9x. This is roughly in line with the industry median, which suggests that even after the recent 25% surge, the stock isn't necessarily overextended. It's actually quite reasonable when you consider their 2026 revenue guidance of $1.54 billion. If they can maintain their 20% plus growth rate while expanding their EBITDA margins towards that 23% target, the current price might look like a bargain a year from now. For those managing their own portfolios through Schwab Intelligent Portfolios or SoFi Active Investing, it's important to watch the institutional churn. While some early investors have taken profits, the entry of new long-term institutional holders provides a higher floor for the stock. This is why we see the intraday dips being bought up so quickly. On Friday, the stock dipped to $23.77 before the buyers stepped in and pushed it to a high of $24.90. That kind of intraday recovery is a classic sign of strong underlying demand. We also have to consider the risk side. No stock moves in a vacuum. If the broader tech sector faces a sell-off due to geopolitical tensions or a sudden spike in inflation, Zeta will likely get caught in the downdraft. Additionally, the integration of the Marigold acquisition needs to stay on track. Large-scale mergers in the software space are notoriously difficult to execute, and any sign of slowing organic growth would be pounced on by the bears. However, the founder-led nature of the company, with David Steinberg at the helm, provides a level of agility that many larger, more bureaucratic competitors lack. As we move into the final weeks of January, the focus will shift to the upcoming earnings report in February. Wall Street is expecting 24 cents per share on $380 million in revenue. If Zeta can deliver a significant beat here, especially in their forward guidance for the Athena effect, we could see a rapid move towards the $30 price target set by analysts at RBC Capital and B. Riley. They aren't just selling software, they're selling an automated growth engine. In summary, the gap between the market's expectation and Zeta's reality is where the opportunity lies. The expectation is a mid-cap ad tech firm. The reality is an AI-integrated enterprise platform with massive data advantages and an improving capital structure. We've seen a breakout on high volume, a successful navigation of short seller attacks, and a strategic pivot towards the most advanced AI models available. The momentum is clearly with the bulls, but as always, always, the key is watching those support levels. If the stock can hold above $22.50 on any market-wide pullbacks, the path to $30 looks increasingly clear. Whether you're using a Fidelity trading platform, a SoFi active investing account, or just keeping an eye on Apple stock and Nvidia stock for broader market sentiment, Zeta Global is proving to be a compelling case study in how a company can reinvent its narrative. It has moved from a defensive posture to an offensive one, and the market is finally starting to pay attention. The increased transparency and the aggressive move towards reducing dilution show a management team that is aligned with shareholders, which is often the most important factor in long-term success. Keep a close watch on the daily volume and the progress of the Athena rollout. Those will be your primary indicators for the next major move. Zeta Global has successfully shifted the conversation from "can they survive" to "how far can they go?" This transition is rarely smooth, but for those who have been watching the data rather than the headlines, the current trajectory is less of a surprise and more of a confirmation of a well-executed plan. The high-volume move to $24.40 isn't just a daily gain, it's a signal.